Welcome back to the Tuesday Target Audio Overview. I'm Constantine.
And I'm Penelope. Today we are diving into week 9 of 52, and Juri von Randow has delivered an absolutely packed issue called More Stimulus and Silicon Assassins.
He really did. Juri kicks things off by pointing out how the market has developed a fascinating immunity to reality. We have carrier strike groups maneuvering in the Middle East, bunker busters dropping, and the Supreme Court completely blowing up the administration's flagship tariff policy.
Everyone anticipates a massive rush for the exits. Meanwhile, equities remain pretty unfazed. Decades of central bank sedation have thoroughly fried the market's risk sensors. Physical world powder kegs have simply been reduced to minor background noise.
The Supreme Court's tariff ruling perfectly illustrates this. Financial media frames the defeat of these emergency trade levies as a chaotic policy blunder. Juri looks right past that noise. He highlights the mechanical aftermath, which quietly guarantees a colossal liquidity injection.
Exactly. Reversing those duties forces the government to issue a potential $160 billion refund to importers and corporations. We are witnessing a perfectly timed stealth stimulus check, and it's being deposited into the U.S. economy right before the midterms.
Speaking of tariffs, the story reloaded incredibly fast. The Supreme Court struck down the tariffs on Friday. The administration had Section 122 tariffs life at 15% by Saturday. Goldman estimates the effective tariff rate dropped by barely 1 percentage point, going from just over 10% to roughly 9%.
Treasury Secretary Besant insists 2026 tariff revenue will be virtually unchanged. The legal authority shifted, and the economic reality barely flinched.
Juri then pivots to the tech sector, revealing a glaring blind spot. The herd spent 2 years throwing cash at anything carrying an AI label. The honeymoon phase abruptly ended, bringing maximum confusion to the space.
Anthropic recently announced its latest update can automate legacy COBOL code that instantly vaporized billions of dollars from established giants like IBM. Artificial intelligence is actively hunting entrenched software monopolies and erasing highly lucrative consulting ecosystems. It's causing maximum anxiety out there.
And it ties into what Juri calls the software infrastructure tax. High gross margins in the software sector are becoming unsustainable in an AI-dominated landscape.
The marginal cost of production is shifting from cheap processors to highly expensive inference chips. Existing providers face escalating costs to maintain their technological edge. Incumbents must sacrifice near-term profitability to fund massive computational expenses to survive this brutal industry transition.
Legacy payment processors are facing parallel struggles. Digital payment pioneers once commanded massive valuation premiums. Years of market share erosion and fierce competition from integrated smartphone wallets have severely crushed their dominance. PayPal recently attracted takeover interest after its stock slid to a decade low.
The entire sector faces brutal consolidation as organic growth stagnates. Survival requires aggressive mergers due to the rapid evaporation of outdated competitive advantages.
Let's talk about market structure. Juri notes the disappearance of dealer gamma. For most of the past year, dealer gamma sat in a supportive range of $4 to $9 billion. It acted as a built-in shock absorber, dampening moves and keeping things orderly.
That cushion has collapsed to near zero. The S&P crossed below Goldman's short-term CTA sell threshold at 6,900. The medium-term trigger sits about 150 points lower at 6,750. One bad headline could cause systematic sellers to pile in extremely fast.
Which brings us to a massive week ahead. Today brings Trump's State of the Union address. Expect tariff rhetoric and potential market-moving soundbites. Consumer confidence data also drops today.
Wednesday is the main event with Nvidia earnings after the close. Thursday features Witkoff and Kushner meeting Iran in Geneva. Friday delivers PPI inflation data. In between all that, we have a parade of Fed speakers and $183 billion in Treasury note supply hitting the market.
Juri outlines some traditional tactics for this tape. Skew is extreme right now. Downside puts are expensive, and upside calls are historically cheap. That makes put spreads attractive for hedging and creates the conditions for a violent squeeze if any positive catalyst emerges.
The buyback blackout is nearly over, with 85% of S&P firms back in their open window. Juri advises staying hedged, keeping ready to capture the snapback. The gap between fear and the index is wide enough to exploit from both sides.
And for the Tuesday target options play, Juri is looking at Nvidia. Implied volatility is elevated. The stock has been range-bound since August. Why not sell the fear with the good old iron condor?
Sure, why not? Since the post-earnings volatility crush has been one of the most reliable patterns in mega-cap tech over the past 2 years. Juri's idea is to sell that fear on both sides. The main risk involves a material earnings surprise pushing Nvidia outside the $170 to $215 corridor, so you have to manage the trade accordingly.
As always, these ideas are for educational purposes, for official trade entries, or to check out the Elite Trader Plan and mentorship calls, head over to the Trade Alerts section in the newsletter.
Juri has built an incredible resource for serious investors looking to master advanced options and risk management. Thanks for tuning in to this week's audio overview, and we'll catch you next time.